Hi, I'm Rich Harvey, CEO and founder of Propertybuyer. And today I've got with me Scott Douglas, who's the principal of IMFG Financial Planners. And we're going to be talking today just briefly about creating a financial plan around buying a property. So Scott, we've got some great questions for you. Could you tell me first of all, how does property fit into creating an overall financial plan?
Thanks, Rich. Well, basically with property is an investment asset that can be lifestyle or investment orientated. And the way it builds into a plan is working out how that value of property and the income generated from it and the debt associated with it fits into your overall plan in terms of how you afford to pay it off, how you are going to end up in the future when you retire. So a plan is really important to create a framework and a sense of what are the priorities that you need to have with owning a property and what's your affordability and how much you should be putting into the property in terms of whether it's a lifestyle property or an investment property and how much debt you take on. So a financial plan is not just about investment, it's actually about cash flow, and it's about future cash flow and paying off those things.
And Scott, with property prices really accelerating in this current boom market that we've got, how could younger people potentially get into the property market?
Well, that's a good question, Rich. With younger people, it's always the first property is the hardest to get in there. And the way I always help young people is just creating a fixed budget that they have to save to get that deposit together. And to do that, you need to have a plan. You need to plan. You need to know what you spend and what you save. And if you can work out at what point in time you'll have a certain amount of money, then that's the starting point. And that's how a young person can build their first property asset, is getting that deposit, that 20%, that 10%, and being realistic about how much they actually save. And so the way you plan that is, well, where is your cash flow going? What are you doing with your savings? Where are you placing it? And what's your actual spending that is lifestyle versus saving? And a plan can identify that quite clearly, and you can create buckets to build that deposit. And then looking at what you can borrow. And what you can borrow is dependent on how much you can save and what your income is. So a plan is very useful for younger people, and it often takes time, and it may be 3 or 4 years before they can get into the property, but if they start early and they plan it, they're more likely to achieve it.
So the earlier the better, and it's not a magic bullet to get a deposit, it's just consistent savings over time is what I'm hearing you say.
Correct, and being realistic and stepping stones. So the issue is that a lot of people think they want to start up here with their first property, but you've got to start somewhere, and being realistic about it may not be the place that you quite wanted, but it gets you on the ladder.
Property versus shares, it's the old age debate about which is the better investment, but tell me your perspective. Which do you think is a better investment and why? And how do you make the decision about whether to invest in property or shares?
Well, this is a great one, Rich. I always enjoy this debate and this discussion. And after 25 years of sitting down with people, talking to them about it, look, there's no one right answer. It's horses for courses, and the answer is it depends. And the reality is you should have from an investment point of view, a well-diversified portfolio of assets that meet your needs in the future.
Have I asked the wrong question? So it should be property and shares. How much of each? Is that a better question?
Well, that's true. Yeah, well, it could be. So, people need a property to live in. If they're going to live in a property, that's fine, and they need to pay that down. But purely from an investment point of view, I can find a share that's done better than a property, and a property that's done better than a share, and a property market and a share market. So you've got to be very careful in comparing the two, because there's technology stocks that have gone up 1,000% in the last 12 months, or the market's up 30%, the share market. And then there's suburbs in Sydney and Melbourne and Brisbane that have gone up 20-30% last year, and some that have gone down. So it is not really, it shouldn't be a competition. It's what's appropriate and in a plan. We look at liquidity and what people need and cash flow. So if they only have one rental property as their retirement asset, then that may not work if they lose the tenant. If they have property and some shares that are paying dividends, because you can't sell the bathroom if you need access to cash. So it's all about being balanced and having quality stocks and quality property. So we follow a philosophy of quality at the right price, diversify and hold it for a period of time. If you meet those four principles, then you will achieve the outcome that you need.
So it's an optimal asset allocation, and you use a lot of science behind that allocation, I presume.
Yeah, correct. Yeah, it's weighting in the different asset classes because they all perform differently over different periods of time, and you need to have your cash buffers, but you also should have property, and property is all about yield as well as capital growth, and stocks, which also has capital growth but also needs to have yield. So the metrics should run across all of them, but it's having that right portfolio that's suitable to the person based on their age and their needs at the time.
Okay. Now, Scott, you talked about cash flow, and retirement might seem a long way off for younger people, but retirement's important. But how can you build an overall plan to create a passive income to support your retirement, and how much do you need to build up as a nest egg?
Well, Rich, this is a very interesting one that often people don't plan enough to get there. You can't suddenly wake up and go, I'm retiring now at 60, 65. Oh, I'm going to create a passive income. Do I have enough? You need to actually plan that 10 years out, 15 years out. And what that is firstly working out what you think you need in cash flow. That's the first starting point, is how much do I need to spend? Yeah. Is it 50,000 a year? Is it 70,000? Is it 100,000? Everyone's different. There's different surveys out there, but most people are.
Do most people underestimate or overestimate, do you find?
I actually think people overestimate a bit. Yeah, particularly later in retirement. A lot of people have too much cash flow when they get older because they don't spend as much. But they probably underestimate a little bit in the early years when they're spending money. Now, you need the passive income, so the income that is generated from not working, and when the employment tap turns off and you need to generate other income, you need to have it tax efficient. So having a bunch of rental properties in your own name, you will probably need double what you need coming out of a super fund to generate the same income because of the tax. So the first thing is just having as much money as possible in the right structures, which is generally a super fund and potentially a trust. If you set that up, then you need to look at what assets are in there. And that passive income, property, depending on what it is probably 3 to 4% at best in terms of cash flow. If you get shares, if you invest in shares, you're probably 3.5 to 5% plus franking credits. So there is a differential there. And you can look at property trusts, which often have a higher level of income, maybe not the capital growth, but it's getting that right, and it's having the income that generates enough to fund your cost of living that doesn't deplete your capital. Okay. And giving you liquidity as well.
Brilliant, thank you. Now, Scott, you mentioned about self-managed super funds. So I'd like to ask you about property and self-managed super funds. How do you create a plan to buy a property in super, and is that a good idea?
Yeah, this has been a very contentious one lately. Back in the 90s, everyone was rushing out setting up self-managed super funds because they could put property in it, and originally you could put your own home in it. And then now it's become a lot more complex arrangement that you need to. My view is it like everything else, it's horses for courses. It's really, do you need one? What are you trying to achieve? Have you got enough money in there? So you really need about $500,000 to start with in a super fund, and that could be a couple. And then you've really got to weigh up, well, is that going to buy a property and take up all the money in the fund? And is that property going to generate enough income to pay out of the fund your retirement income or what you need or the expenses of the fund? So you can go and borrow. That's tricky. People do that, and there are loan arrangements to do that. More for younger people that are trying to build their superannuation. But towards retirement and in retirement, properties are okay in a self-managed super fund, as long as it's there with enough money also in the fund to pay for income payments and other things. So a balance. My view is that it's the bigger funds that have got a lot of shares in them, a lot of cash, some other assets, and you might have a rental property in there. But if the property is the main part of the fund and you're a bit older and you're nearing retirement, then it's not the best idea. A lot of people might liquidate that and move into other types of assets within the fund. It's a costly exercise to run the fund, so you need a reasonable amount of money in there and a reasonable return on it. and it will depend on what you own, where you buy, and having the right type of property within it.
So Scott, good debt versus bad debt. At what stage of life should you really start accumulating and loading up with debt? And at what stage of life should you really start paying down your debt? There's a bit of a tricky question there, but tell me your thoughts on that.
Yeah, so good debt versus bad debt. I mean, a lot of people, I call it having quality debt. And people go, what's quality debt? But debt's great. Yeah. People should borrow money. People should take on board debt. Companies borrow money. Individuals should borrow money. But when you have debt, you've got to just be careful that the weighting between debt on your own family home that you can't claim a tax deduction for, that needs to be paid off over time, is not disproportionate to the debt you may have on rental properties or prohibiting you from buying a rental property. So with rental properties, that's tax deductible. You can claim the interest on that loan and offset that against the rent. And when you're younger, it's a great thing to do if you can get into a investment property at a young age with debt. As you get towards 50, 55, 60, you don't want to be going into more bad debt or bad quality debt, as in non-deductible debt. So if you're taking out more loans just to continually upgrade your home, eventually you're going to have to sell the home or pay it off or wait for some money coming from somewhere. And it prohibits you from being able to go and gear other things that could be good investment opportunities. Your own home, sure, the asset's tax-free and it's a place to live, but loading up with debt, my view is that you need to have a plan around how long that will take to reduce that non-deductible debt. And because if it's well into retirement, then that may not be the right decision to go and buy another house for another $1 million. Just because the bank lends it to you, you've got to remember they're in the business of lending money. Yeah. It's a plan around reducing non-deductible debt. Yep. So you can fund other things like a rental property, like money into super, and enjoy your life, because if your own home doesn't actually generate cash flow.
Yeah, excellent. Okay, and if I can just finish with one random question. What's the best financial tip you've ever had and used in your own life?
Right, the best financial tip I've ever had. Well, I would have to say my best financial tip is really spending less than you earn. That's
pretty simple.
It's very simple. It's postponing consumption,
right?
And not spending money on things that you really don't have to have. Yeah. Because $1 spent on consumption is $1 that you don't have to invest. Yeah. Yeah. And if you, doesn't matter what you own, it's actually what you spend.
Brilliant. Well, I'm Rich Harvey, CEO of Propertybuyer. Thanks, Scott Douglas from IMFG Financial Planning. If you'd like any more information about creating a financial plan or how to buy a property or how to combine the two, please get in touch with me. We'd love to help you and we can make introductions. Thanks for watching.
Thanks, Rich. Thanks.